Thank you for joining us on our 6-minute overview of 2018's economic and market outlook. Our theme for this year is the return of the business cycle. We often talk about cycles in terms of the economic periods of recession and expansion. And while we're not returning to the beginning of that cycle, what we're referring to here is the return of the traditional drivers that propel the cycle. We're looking to the forces that have historically supported economic and market growth before we had entered into this recent period of accommodative monetary policy. We expect to return to an environment in which investors may be rewarded for their ability to focus on business fundamentals as markets respond to the shift from monetary to fiscal support and greater incentives for entrepreneurial risk-taking. 5 factors to consider in this. First, fiscal coordination. The next step for the U.S. economy will involve a combination of infrastructure spending, tax reform, and regulatory relief. Business investment. To remain successful at this point in the cycle, businesses will need to invest in property, plants, and equipment. Earnings growth. Better global growth, a pickup in business spending, and lower corporate tax rates should all support better earnings. Active management. A return to fundamental investing, where investors can determine winners and losers based on earnings, sales, and cash flow, etc., should lead to continued momentum for active management in 2018. Bonds. Bonds will remain an important part of a well-balanced, diversified portfolio and can help mitigate risk should we experience any equity market pullbacks. Our forecasts. The economy. U.S. GDP growth should pick up momentum thanks to fiscal support with the additional help from a pickup in business spending, while a strong labor market should continue to support consumer spending. Stocks. Earnings growth is the key to our double-digit stock forecast. The S&P 500 may be well-positioned to generate strong earnings thanks to better global growth and lower corporate tax rates. Bonds. Given our expectations for a gradual pickup in interest rates across the yield curve, we expect flat to low single-digit returns for U.S. bonds. We've broken down our investment recommendations into 3 categories: heroes, sidekicks, and the expendables. Among the heroes are small caps, as they are strong beneficiaries of lower corporate tax rates. And value stocks, as rising rates support strong financials and relative valuations are becoming attractive. Cyclical stocks, emerging markets, investment-grade corporates round out the category. The sidekicks include U.S. stocks, as accelerating growth and fiscal stimulus provide the edge. Growth stocks, mortgage-backed securities, high-yield corporates, and bank loans are also on the list. The expendables are developed foreign bonds and developed international stocks, as we believe the European growth may have peaked, while structural concerns still remain. Long-term high-quality bonds and U.S. defensive stocks may also come up short in 2018. More details on the global economic growth backdrop. As you can see, the expectation is for stronger 2018 GDP in the U.S. Still lower GDP numbers in developed international, hence their inclusion in the expendables column on the previous slide. And strong 4.8% GDP growth in emerging markets continue to make them attractive. Again, earnings are the key to our double-digit stock forecast. And with tax reform passed, these earnings may get another 5 to 6% boost, putting numbers well above the consensus $146 per share that are potentially in play. 2 other points regarding stocks: small caps and growth versus value. First, small caps generally pay higher tax rates than large caps. We estimate about 5% higher on average. So tax reform should benefit this group significantly. Smaller cap companies, which are more domestically oriented, are also in a better position to weather a potentially stronger dollar due to their higher proportion of domestic revenue. And we see the risk to small caps related to the age of the business cycle as manageable at this stage. But small caps may underperform should a potential stock market correction materialize. Finally, growth has been on a roll, outperforming value significantly in 2017. That leadership is nothing new, as growth has outpaced value consistently for a decade in what has become one of the longest periods of growth outperformance in history. Last point to make is regarding why we believe active management should outperform passive strategies such as indexing and ETFs. First, we've seen a lower correlation and a greater dispersion across individual securities, sectors, and asset classes, creating more investment opportunities for active managers. Next, rising interest rates and inflation lead to variability in costs of capital and profit margin across companies and industries, which should lead to better capital investment decisions. And although volatilities remain low, it's expected to increase in 2018 and should help active strategies by creating more opportunities. A broader range of investments do well with stronger market breadth. Thus, the odds of active manager success increase as long as correlations remain low. Finally, as the market likely becomes more discerning about company fundamentals and valuations, factors that are favored by most active managers, active strategies should benefit. I'd like to thank you for joining us for the last 6 minutes. And as always, if you have any questions, please don't hesitate to reach out. Thanks, and have a great day.